Hey, welcome back to the NearSight and FarSight podcast brought to you by the professionals at InSight. My name's Kevin Taylor. This is part 2 in a series where we're discussing our new partnership with Upside Avenue and its sister company, the Casoro Group. In this segment, we're going to talk about the process that goes into selecting good real estate assets for an investment portfolio. We have John and Louise who will do a brief introduction, and then we're going to talk about in more detail the process of asset selection and what goes into finding a good real estate project to invest in. John, Louise?
Thanks, Kevin. I'm John Mendoza, Vice President of Acquisitions at Casoro Group. We're a vertically integrated multifamily investor and operator. We have in-house property management, in-house construction, and in-house asset management. Our mission is to provide better homes for better lives, which means we add value to our communities by focusing on the residents. We have an experienced track record and have been around for 20 years. We have been investing in Texas for over 15 of those years. In 2010, we were fortunate to be 11th place in Inc. magazine's fastest growing real estate companies, rising from 27th the year before. And our assets have won numerous awards. One of our prized awards has been Best Places to Work in Commercial Real Estate that we won this month and will be announced later on.
Thanks, Kevin. My name is Luis Samora, and I'm the Director of Investor Relations here at Upside Avenue. Upside Avenue was created by our sponsor company, Casoro Group, to break the investment barriers so everyone could reap the benefits of real estate investing. On one hand, you have Casoro Group with the institutional capital and the deals, and on the other hand, you have Upside Avenue opening that door for the everyday investor. Upside Avenue is a non-traded public REIT that was launched back in 2018. In that year, we won the 2018 Commercial Real Estate Tech Award, and we have been backed by Casoro Group ever since.
All right, fantastic. So a lot of our clients, they come to us because of our due diligence and our process, our ability to find good, provocative, lasting investments for them, because it's, dependent on their retirement, they're going to pay for education. It's really very visceral for them. So I want to know a little bit more about the combination of your two companies, the Upside Avenue and the Casoro Group's process for identifying new opportunities, and what's been a reliable list of metrics in the past, and how you found success applying those metrics to the properties that you've chosen.
Yeah, that's a great question, Kevin. For us, we look for median household incomes of at least $60,000 within a 1 or 3 mile radius. In addition, we also overlay home values of at least $175,000. So we use Redfin for that. And then we also like to sprinkle in school ratings. So good school ratings, good home values, and solid incomes provide for great properties and good business plans. So that's really kind of the goalpost that we look for when looking for specific submarkets. And then we dig into specific properties thereafter.
That's awesome. And so, we're pretty familiar with real estate, going back decades, and what makes for good real estate acquisitions. Traditionally, we've liked looking at cash flows, understanding those more reliable metrics. Are those still the metrics that we use going into the next decade, the next century of real estate investing? Are there any other reliable metrics that our investors should be focused on when they're determining a good real estate investment for themselves or a good partner like yourselves?
So yes, Kevin, we definitely focus on cash flow. For example, we focus on the going-in yield of properties. We also look at the 5-year levered and unlevered returns, and cash multiples are also very important for us. Aside from that, we also look at metrics such as occupancy of the properties, right? Are they highly occupied or underoccupied? And also economic occupancy is something that we focus on. One thing that we've noticed during COVID is that there are some potential bad debt issues with folks losing their jobs and incomes. So we look at bad debt, for example, when folks are paying their rent. Are they paying it mostly on the 3rd of the month or the 7th of the month, right? And those metrics do change as the market fluctuates. So some of those numbers are moving targets, but at the end of the day, those are still really important metrics that we focus on.
One of the things that's important about that appears apparent on Upside Avenue is your selection of operating in the B to C plus space. Maybe you can do a little bit of explanation as to what that asset tiering means to the rank and file investor, somebody who's new to the real estate investment trust space, and why you think that that's going to be the right place for Upside Avenue and the Casoro Group.
Yeah, exactly, Kevin. I think I'm going to start really high level with REITs in general, just because there's so many different kinds of REITs in the commercial real estate space. Obviously, you have your office space, you have your retail, but Upside Avenue really focuses on multifamily. So right now, we only have apartment buildings in the portfolio, but we do look at student housing and senior living because those do encompass the same kind of metrics and qualifications that we're looking for and where we specialize in. But like you said, we do have some C plus all the way up to B in the portfolio right now. And the reason why we like that range is because this range is really recession proof. They're more likely to have, our customers are more likely to need housing instead of see it as a luxury. And so most of these properties are kind of built in the 70s and 80s. And the reason why we focus on that is because our investment thesis has been in going and purchasing these properties, doing a little bit of value add upgrades. So this is in the amenities space. Some of these kitchens are 20 years old. We can go in and update these kitchens. We can add some high-speed internet, etc. And this really drives the value of the property. And that has been what we've historically looked at. The reason why we're kind of moving away from the C plus range more into the B plus range, which is properties that were built more closer to the 90s and after, was because these older properties are becoming really expensive to maintain. I mean, the perfect example was this Winter Storm Uri. These properties that were built 30 years ago, their pipes are older. They suffered some water damage that was more expensive to repair than a newer apartment. And then there's also the factor is Texas is growing exponentially and seeing a lot of corporations that are relocating. These corporations are tending to hire knowledge workers versus the workforce housing demographic that we were seeing before in these B, C plus range. And these knowledge workers are moving to Texas exponentially, and we see that growth in that market. So the B plus range is becoming more and more attractive to Upside Avenue and Casoro as a whole. We see that with workforce housing, AI automation is taking away jobs, and we don't see the wage growth that we can see with this knowledge workforce.
Thanks, guys. So if somebody is interested, obviously, we have a good partnership and we're driving them towards you. Where else can they go to get more information or just contact you directly?
Thanks, Kevin, so much for having us. Now, if anyone has any questions, Casoro Group or Upside Avenue, you can shoot me an email at lzamora, which is spelled LZAMORA @upsideavenue.com. Visit our website at upsideavenue.com, or just reach out to Kevin and we can be sure to connect. Thanks and have a good day.
Great, thanks. That's awesome. Well, this has been part 2 in the series. If you missed out on part 1, please rewind, go find either on YouTube or on the investmentwithinsight.com website, the first part where we actually discuss the market set and the market opportunities. And in part 3, we're going to discuss with John and with Luis the performance of their fund and a little bit more detail as to how they get there. Thanks again. This has been NearSight and FarSight with the investment professionals at InSight. Thanks.